Good day. After looking at lots of functionality in QAD, such as MRP, forecasting, CRP, advanced forecasting, shop floor control, how to sim load data into QAD, and just last month, the specifics of MRP in terms of bills, material, and items. Today, let's talk about one of my favorite subjects, accounting. I think maybe I always wanted to be an accountant because early on in my career, I noted that the accountants pretty well controlled how we in operations, or any part of the ERP system for that matter, basically told us what to do and how to do it. But before we actually get into the meat of QAD accounting, I'd like to talk just briefly about accounting in general. We all remember Cuba Gooding Jr. and his rant, "Show me the money," to Tom Cruise and Jerry Maguire. And this is true for all of those who use the supply chain. Now, I have always told my Apex classes that accounting rules our lives. Although we in supply chain are always dealing with quantity on hand, work order quantities, PO quantities, and sales order quantities, we must always remember that we are dealing with the value or vector of materials that is money in our organization. As we progress through today's short seminar, I would like us first of all to understand a little bit about the history of accounting. That is the background of double entry bookkeeping, what the VENICE merchants had to do with that process, just a little bit about the periodic accounting process itself. Then a discussion of debits and credits and what that means for inventory control and supply chain. Then a review of the basic accounting equation. What information is included in the income statement and the value of the statement of the balance sheet, or what we call net worth. Then we will have a look at another couple of common accounting reports, and finally take a couple of quick words about accounting ratios. As always, when one looks at a specific subject or area in the ERP arena, there are several terms and definitions that we will need to understand and become familiar with. If you do not understand a particular term that I use, you can look it up in Google or the QAD knowledge base, or just send Denise or I a quick email at 32Soft, and we will do our best to elucidate the issue. As always, when we deal with any functionality in QAD, we want to make sure we have a good, well thought out work instruction, and we should have a data dictionary or wiki to define all of the fields and values that are used by our company. In the late 1500s, with the increase in trade in and around Venice or Italy, merchants started to need to keep track of activities around the barter of goods and services. One Fra Luca Bartolomeo di Paccoli, an Italian mathematician, a Franciscan friar, a collaborator with Leonardo da Vinci, and an earlier contributor to the field we now know as accounting, published a book in 1494 called Summa d'Arithmetic Divina Proposta. My Italian is very bad, but this is one of the first books on the concept of double entry bookkeeping. Paccoli first detailed the 5 basic account groups: assets, which have value and are expected to benefit the future operation of the business; cash, accounts receivable, inventory, machinery, and building are examples. Then we have liabilities, or obligations or amounts owed by the company, such as accounts payable, wage payable, long-term debt. These are examples of liability. And then owner's equity. This is the difference between assets and liability. It represents what is left for the owners of the business after all the liabilities are paid. Owner's equity is created either by the owners investing money in the business through the operation of the business when it earns a profit. It is decreased when owners take money out of the business or when the business loses money. The other two general accounts are revenue. These are fees earned from providing services and amounts of material or merchandise sold, and expenses. And expenses is a reduction of the value of the asset and is used to generate general revenue. Pacoli also helped define the use of debits and credits and detail out what is now known as the accounting cycle of journals and ledgers. The accounting cycle or process that Pacoli helped define can be summarized as these 8 steps. It is done on a periodic basis, typically monthly and yearly. First of all, we record the opening entries. We collect business transactions. This is where ERP comes into play. We journalize or record transactions in journals, post those journals to the ledger, record adjusting entries if there are any, prepare a trial balance from the ledger, create the financial statements, and close all the records with closing entries. That's the accounting cycle. Pacoli also helped develop the basic accounting equation, which states that assets, that what we have, equals liabilities, that what we owe, plus equity, the difference between the two. Hopefully, that is a positive value. Again, I always ask my classes, do you know your own personal net worth? You should be able to use this general basic accounting equation to find out how much you are worth and if you are getting better over time. Under assets, we find such things as cash, accounts receivable. From a supply chain point of view, this is where you would find sales in our ERP system. Notes payable, supplies. From a supply chain point of view, this is where we would find inventory and WIP in our ERP system, and land equipment. Under liabilities, we find accounts payable. Again, from a supply chain point of view, this is where we would find purchase orders in our ERP system, and notes payable, etc. Under equity or net worth of the stockholders, we would find common stock, retained earnings, returned earnings, takes previous returned earnings, and adds to subtract net income or net loss through either revenues or expenses. So those are the elements of what is referred to as the basic accounting question. Again, as we see from Pacoli, the basics of accounting are controlled in journals and ledgers, where entries into this journal and ledger must be always equal. This is normally referred to as the double entry accounting system. Each transaction must affect 2 or more accounts to keep the left side and right side of the basic accounting equation in balance. As we can see from the diagram, debits on the left normally represent assets with debit balances, and credits normally on the left also represent liabilities and owner equities with credit balances. From the basic accounting equation, where assets equals liabilities plus owner's equity, we can increase or decrease the value of an account by the use of these debits and credits. You can see that the equation must be in balance every time you do a transaction. Remember then that assets equals liabilities plus equity. A little on the rules of debits and credits. First, we need to ask ourselves what elements are affected, then what accounts are affected, and did the account go up or down? If an asset increases or decreases, the other side must have a corresponding entry. Here we have just a couple of examples how debits and credits might work. Let's say we're going to invest $5 in the business to start the organization. So let's invest $5. That would increase cash, an asset, with the debit. And it would simultaneously increase capital, equity, with the credit. Remembering that both sides of the equation must be equal. So now let's sell a customer a product and collect $20. That would increase cash asset and increase revenue, net income or net loss on the revenue under the liability account. From the supply chain point of view, this is where we live. When we sell something, that means we probably have inventory, and so we process a transaction, maybe a sales order, to remove that item from quantity on hand and ship to a customer. Accounting sees all of these transactions in their journals and entries. The supply chain would see this in our transaction history table. Since most of us are concerned with our net worth or equity, we would be interested in the effects of the accounting transactions on equity, either increasing or decreasing that equity. So revenues result from business activities entered into to earn profit, and expenses result from the support of those revenues. These then give us the resultant equity, that is the owner's share of the business. Let's now take a look at a series of events in the life of a company and how these are recorded in the ledger. Let's go ahead and invest $10,000 from the business owner. The owner is going to pay some cash for supplies. We're going to buy some insurance. We're going to buy some supplies on account from a vendor. And then the owner is going to pay cash on that account to the vendor. So let's look at the individual transactions. So first of all, we receive cash from the owner as investment. So transactions during the accounting period, debit cash for $10,000 and credit equity for $10,000. Next, we paid cash for some supplies, $1,577. So we credit cash, $1,577, is reduced from the $10,000 to $8,423, and we debit supplies, $1,577, and supplies are increased by that value. From a supply chain point of view, this would be the equivalent of placing a purchase order and receiving the inventory into inventory. Third, we're going to pay for some insurance, $1,200. So we're going to credit cash for $1,200, and we're going to debit prepaid insurance for $1,200. Not any direct effect on inventory or supply, as there are many events in the process of running a company that do not have direct effect on us in the supply chain. 4, we're going to buy some supplies on account from a vendor. So the cash remains at $7,223, and liabilities are increased to $2,720. Supplies are increased or debited up to $4,297. Previous value of 15 plus the 270 equals that for 297. And then lastly, we're going to pay cash on account to the vendor, $1,360. So cash is reduced by $1,360 to $5,863. The 722.23 minus the 1,360 equals that 586.63. So supplies remain the same at $4,297, as this is a financial transaction that does not directly affect inventory or supply chain. And since we paid cash to the vendor, accounts payable is decreased, a debit on the liability side, which brings the balance down from $2,720 to $1,360. Capital remains at $10,000. So, to summarize, we can see that all of these transactions took place during the accounting period, and for your organization, there's probably thousands more. To summarize the process of these transactions, we would look to 2513.18 General Ledger Transaction Browse or 2515.1 the Transaction Report. Now that we have seen the recorded in the ledgers and transactions of transaction for the period, we can now look at the income statement. The income statement is usually considered the most important financial statement since it presents the operating results of an entity as it presents the revenues and expenses and profit and loss generated during the reporting period. We have revenues, which come from the sales of goods and services. These, again, increase the owner's equity. And we have expenses. Expenses occurred in making the revenue, which decreases the owner's entry. And these are classified either as cost of goods sold or general and administrative expenses. So the income statement, or the income of the organization, is equal to the revenue minus the expenses. Fairly simple. Here we have an example of an income statement. It starts first with the revenue. So we have $1,500,000 of revenue. And then we have to look at what the cost to produce the product that we have sold to arrive at that revenue. So we have direct labor, $300,000. We have $500,000 of direct material. We attach $400,000 of overhead to that for a total of $1,200,000 worth of cost of goods sold. This gives us the gross margin of $300,000 and gross margin income of the organization attached by or associated with producing the product. The general and administrative expenses are expenses that are generally just there, whether you're going to produce or not, rent, telephone, those kinds of general administrative, which comes down to a net income, which tells you whether the company has a profit or loss for the period. So let's look at materials management in terms of this income statement. And let's say if we could reduce material costs by, say, $50,000 through better materials management, where maybe we're going to fire the supply chain manager and hire a new one, or we're going to do a better job of running our ERP system or MRP. However we do that, let's see the effect of reducing that materials cost by $50,000. So we have the $1,500,000 that we saw before. We've got the labor, and now through better materials management, the material portion of the $500,000 is reduced to $450,000. We've still got the $400,000 worth of overhead, so now we have a total cost of goods sold of $1,150,000. This says we've got a gross margin of $350,000. Our G&A was $150,000, and our net profit was $200,000. Remember, the old net profit was $150,000. So we have just, through better materials management, increased the profit of the organization by another $50,000. So it's a direct relationship. The better you do in materials management, the better the organization does. That's why we are so important in terms of how we use these ERP systems. In QAD, this income statement can be viewed at 2515.5, and we can use actual budget variance, percentage variance options to generate various formats or combinations of the income statement. Balance sheet presents the assets and liabilities and equity of the entity as of a reporting date. So this is information presented at a specific point in time. The report is structured so that the total of all assets equals the total of all liabilities and equity, known as the accounting equation. This is typically considered the second most important financial statement, since it provides information about the liquidity and capitalization of the organization. This is a good place to mention GAAP, the Generally Accepted Accounting Principles, as set forth in the pronouncements of the Financial Accounting Standards Board, the FASB. This GAAP process refers to a common set of accounting principles and standards and procedures that companies must follow when they compile their financial statements. GAAP is a combination of these authorization standards and are set by these FASB policy boards. The balance sheet is a snapshot, as we said before, the firm's ability to pay its liabilities at a point in time. It does not tell anything about how that position was reached. The balance sheet equation summarizes the relationship between assets and liabilities and owner's equity. There are other financial statements that you will look at later, such as sources and uses of fund, that show how the balance sheet accounts changed from one snapshot to the next. So a couple of examples of how the balance sheet process works. If we've got equity of $1,000 and liabilities of $800, what is the asset of the organization? Well, the asset in this case is the $800 but the $1,000, or $1,800 worth of assets. So what if we do a little simple math and subtract liabilities from each side, and we can see that owner equity equals assets minus liabilities. So if we have assets of 1,000, we have liabilities of 600, we can see that we as owners have $400 of equity in the organization. So that's the balance sheet. In QAD, it can be found in 2515.4, the balance sheet report. This balance sheet lets you view monthly, quarterly comparisons for actuals, budgets, calculate variances, etc., etc. The sources of or uses of fund is a summary of the changes in financial position from one period to another. You can find this in QAD and our cash flow report process. Very valuable reporting process is what is called the break-even analysis. This is the point at which the total cost and total revenue are equal. There is no net loss or gain, and so no one or one has basically broken even. So this is very valuable for the supply chain. Ratio analysis is a concept that goes all the way back to Pacoli at the inception of accounting. The term ratio analysis simply refers to the analysis of financial statements in conjunction with interpretations of financial results for a particular period, derived with the help of ratios, numerators and denominators. Such analysis as liquidity, quick ratios, profitability ratios, working capital, inventory, turnover, these help the officers and financial persons of the organization understand the status and process of the valuation of the company. The better a supply chain member understands these values, the more effective is that supply chain organization going to be in the growth of the company's health and profit. So now that we have a basic grasp of the origins of the history of accounting, some understanding of double entry bookkeeping, the use of debits and credits, what an income statement and a balance sheet are, along with some other basic data, we are prepared now for the next two accounting-oriented webinars to be presented by 32Soft. That is, Show Me the Money, Insights for Supply Chain Players, May 15th, and the June webinar, which is going to be on QED variance reporting, Why is Accounting Upset? So we want to thank you for your attention. If you've got any questions on the presentation, please contact 32Soft, either Denise or I, and we will do our best to provide clarification. Thank you so much for your attention.